Just to follow up on payment for order flow, I mean, most viewers of the trading activity in the last 30, 40 years agree that the American investor has never gotten a better deal. Not only have commissions essentially go to zero, but even trading costs are much lower. Execution quality has improved dramatically in the last 30 years. I know there's a little bit of debate about exactly how much, but the average investor seems to be getting a very good deal. Do you feel you're going to be actually able to demonstrate a real harm from payment for order flow, number one? And number two, could you tell us what comes next here? You've got the commission with your staff with a very excellent report on the facts, but not a lot of direction about where it should be going. Is the commission then going to meet and make recommendations or make rule changes from here? What's the path here forward after this commission staff report?
Well, let me say this. You're right that our markets have gotten more have moved to zero commission, but it doesn't mean it's free. There's still a payment underneath these applications. It also doesn't mean that it's always best execution. And we've had cases where we've announced in the last 18 months where there has been this conflict between the broker on the one hand and this payment for order flow on the other. And let me just remind your viewer that if you place a retail market order, as shown in this report, the vast majority of those don't go to the transparent lit markets. They go to the dark market, these pools that are not competing. And so I've asked staff, can we achieve this simple concept that your order, when you place it, competes with other orders? And buyers, if you're selling, will compete to get and to pay you, hopefully, the best execution for that price, order by order by order. That's what I've asked staff. And I think that that's an important concept of competition that helps the investors on one side, helps the companies on the other side that are raising money in our markets.
Well, Mr. Chairman, again, I want to praise the staff because those who read this will know there was not a vast conspiracy against them, which was really the topic that I know a lot of us felt we were really razzed by because we were all in on some sort of Citadel conspiracy. I think that's completely bustedness. But there was something on page 12 that disturbed me. You talk about some in the marketplace may possess superior information about underlying assets. That, sir, I think is illegal. Did we discover that some had superior information and therefore should be in front of the commission to find out what the heck went on?
Well, I think that you chose the words carefully, may be there. But when order flow, when trading is being purchased and sent to one wholesaler or another wholesaler, then they have information that the rest of the market may not have, at least for a short period of time. And even milliseconds matter in these markets. And so that's what we're also looking at. You're absolutely right that I think from a policy perspective, want to look at that and how we instill greater competition, in essence, for that data as well as for that order flow.
Chair Gensler, David Faber here. We had you on not that long ago, obviously a long-ranging interview. I wanted to come back to SPACs, if I might, just for a moment. Haven't really heard that much from the SEC yet, and I wonder where you are, because it does appear that the market has been making its voice heard when it comes to SPACs. We are seeing the sponsors changing their compensation arrangements. We've seen the PIPE market really freeze up. And so is the market doing its job, and the SEC therefore perhaps doesn't have to take significant action in any way in terms of regulation for SPACs?
I think that there is a need here for greater transparency, greater disclosure. These are innovations that have happened in our market, special purpose acquisition companies, but they're costly, and they may also have inherent conflicts between a promoter or sponsor who's taking generally about 20% of the offering. That if you raise $1 billion, that's $200 million. Can I repeat the number? $200 million to basically raise money in a blank check type of shell company. And then you have 2 years to go out and try to buy something. And there's also this conflict that If you don't buy something, you don't get, the promoter, the sponsor doesn't get that 20%. So there's an incentive to buy something even if it's not the best purchase in the world, particularly as the clock is ticking and you get to the end of the 2 years. So I know I've said this a lot about staff working on recommendations. These rules are highly detailed. We need to work on the economic analysis, which is so critical to good decision making. There are 5 commissioners. And so the process does take a number of months. And sometimes the public says, oh, where's that document or where's that rule proposal? But I would envision that staff will put something up to our 5-member commission. And if there's the support of the commission, we'll put it out to public comment with regard to SPACs, with regard to a number of these other topics we've talked about as well.